What's up guys, welcome back to the channel, and if you are new here, welcome. My name is Johan Lorenzo, and in this channel we talk about personal finance and how to make money in the stock market through dividend growth investing and trading options. If that's something you want to be a part of, I'm inviting you to subscribe to the channel and come along for the ride. So, with all that said, the day has finally come. The video you've all been waiting for. We're selling covered calls today, baby. And I'm going to show you guys how I make money by simply owning shares. Yes, you heard me right. In this video, I'm going to show you how you too can make money by holding shares in your account, regardless if the stock price goes up or down. You're going to get paid, period. And this strategy has a 100% chance of profit. So if you're ready to make some money trading options, all I ask of you is to please give this video a big thumbs up so it helps my little channel grow and it helps push this content to the people who are looking for it. And I promise you, by the end of this video, you will know how to execute this option strategy on your own. So without further ado, let's get into the video. So for the sake of this video, I'm just gonna purchase 100 shares of Tesla straight up. Even though I think it might drop a little bit and give me a little bit of a better entry, I'm just gonna purchase them straight up so you guys can see how I do sell a covered call on these shares and how I can average down the price from where I'm currently buying it right now. So let's get into that, all right? We're gonna go to Tesla, which we have it here on the main screen. And on the bottom right, I'm gonna click trade. Now we're gonna click buy because we want to buy 100 shares of the stock. Remember, when you're selling a covered call, you need to own 100 shares of the stock in order to sell that covered call. Because if you don't, you're not going to be able to. You need to have 100 shares because each contract controls 100 shares of that underlying asset. In this example, it is Tesla. So we are going to do 100 shares, which is going to run us about $70,000, 642. So 706.42 times 100, $70,642. We're going to make this let's just do a market order, and we're going to buy them in shares, obviously. So we're going to do review. We're going to swipe up to submit the order, and we should get filled here pretty soon. All right, there you go. We have officially purchased 100 shares of Tesla for 706.56. That is our average price, right? Because that's what we put the order in. Now, let's get to the fun part. We're going to go to our main screen here, and as you can see, my buying power is only $79,567 because I did purchase over $70,000 of Tesla right now. We're going to go to where it says stocks, right? You're going to click on Tesla because that's what I'm going to be selling the covered call on. I'm going to hit trade on the bottom right. Now on the top, I'm going to do trade options. And here we go again. Like from the last video of selling the covered put, the cash secured put, you have your dates on the top. That's the most important thing coming up right now. What is the expiration date that I'm looking for? We're going to do this week, the 27th. So I'm going to click August 27th. I'm going to go for sell. You have to make sure you click sell, and then you got to make sure you click call. We're going to do sell call, and then let this thing load up here. And then you want to pick what you will sell the shares for if they do climb up. So right now, Tesla being at 706, I do feel comfortable selling this right away. If it does drop, I do feel comfortable holding on to the shares as well. Because why? These strategies that I'm telling you guys, cash secured puts, and in this instance, selling covered calls, I only do this with stocks that I'm willing to hold long-term anyway. So in this scenario, if it sells, that's fine. I'll make money on the shares and I'll collect a premium. If it doesn't sell and Tesla drops to 680, 650, that's absolutely fine as well, because I don't mind holding these shares long term. So in this instance, right now we're going to do 710, for example. We're going to do 710. We're going to sell one contract because we only have 100 shares of Tesla. And we're going to collect, the bid is 7.55 and the ask is 7.60. We're going to do, let's leave it at 7.55, okay? And we're going to review that. We're going to swipe up to submit the order, and we should get filled here pretty soon. There you go. There you have it. We have our covered call sold. What does that mean? Let's go into the main screen again. So we're going to go to the main screen where it says investing, right? We're going to come down to where it says options. That's where your options position will be on top of your stocks, if you guys can see that, okay? Okay, so now where it says options, we're going to click on that. It's going to give you everything about your options position, okay? So here we go, guys. Where it says your position, you obviously have a -1 because you sold one contract. It'll give you your break-even price, which you might not understand that because you're saying, well, you sold this for $7.10 and your break-even is $717.55. What it's doing for you, it's adding the premium that you collected. So if you do sell that stock at $710, remember, you also collected $7.55. You got to add that to what you're making because that's a part of your gain. So you're really selling it for $717.55. Now, let's say Tesla only goes to $712. Well, guess what? You're going to sell it because your strike price is for $710, but it's like if you're really collecting $717 for it because you collected $755 for your contract and you're selling it for $710. Even though Tesla only gets to $712, it's really like if you sold it for $717.55. Let's say by August 27th, this Friday, Tesla is at $712. You're going to end up selling them because you had your strike price for $710. I mean, it's not guaranteed. I've had it happen where it goes over my strike price and the person on the other end, they didn't buy the shares, which is a win-win for me anyway. But chances are, very high chance, you will sell the shares if it does go over the strike price. So let's go back to the point here. So I know it can get a little confusing if you're new to options, and I tend to get a little hyped up when making these options plays, to be honest. So I'm going to break it down one more time in layman's terms here, all right? This average credit that you're seeing of $7.55 is the premium I collected for selling this covered call. And you've got to remember, you always multiply that number times 100 because an options contract controls 100 shares of the stock. In plain English, I'm getting paid $755 to give someone the right, but not the obligation, to purchase these shares of Tesla on or before the date of expiration, which in this case, it is this coming Friday, August 27th. If Tesla stock is below $710 by the end of the day on Friday, I'm going to keep my 100 shares of Tesla and I'm going to pocket the premium of $755. And on the contrary, if Tesla stock happens to go above the $710 strike price by Friday, and let's say it goes to $725, I'm only going to get paid $710 per share because that's what the strike price was in the contract. So the person on the other end of this deal will be able to purchase Tesla for $710 per share, even though it would be worth $725 per share. That's a pretty good deal. But then again, that's why they paid a premium of $755, so they can have the rights to do that if it goes in their favor. Think of a premium on an options contract sort of like your car insurance, right? Let's say you have Geico for your car insurance, and you pay Geico $150 a month. If you don't crash that month, you don't go knocking on the door of Geico and say, hey Geico, I didn't crash my car, let me get my $150 back. No, they simply keep that because that's the insurance you pay in case you crash your car. Now, if you go and destroy your car and you total your car, that $150 a month that you pay, guess what? Geico has to front the bill because you paid them the premium to say, hey, if I destroy this car, you got to pay for it, right? That's why you pay insurance. Well, for the most part, but you catch my drift. I want to thank you all for watching, and I hope you guys enjoyed the video and got some value out of it. If you have any questions, feel free to drop them down in the comments below. I will get back to each and every single one of you. With all that being said, until next time, peace!